Welcome back to the Deep Dive. Today we're going to cut through some headlines, specifically looking at why this huge, heavily promoted youth savings plan in Korea ended up with, well, basically zero people getting the top interest rate promised.
Yeah, zero. It's quite something.
And that failure, it's really just where we start. Our source materials today give us this fascinating glimpse into, the gap between what policy promises and what the fine print actually delivers. We're going to use that as a lens to look at two other really big areas in Korean finance. First, this massive 24 trillion KRW push to decentralize the economy.
A huge number.
Right. And then how the big financial players are kind of reacting to the pressure on digital trust and social value.
And what's really interesting, I think, is how these three seemingly separate topics, they all kind of circle back to these core ideas of trust, access, and importantly, accountability in the financial system. We're not just going to be looking at the big figures today. We're trying to get into the why. Are these policies really designed to help people? Or are they more about regulatory goals and maybe corporate self-interest?
Yeah, that's the real question.
And that's what we'll dig into by looking at the details.
Okay, well, let's unpack it then. We're starting small, like individual savings accounts for young adults, then zooming way out to this huge regional strategy, and finally landing right in the corporate boardroom. So first up, this policy failure that's caused a lot of frustration. The Youth Leap account. It launched with huge fanfare, right? Promising young people this maximum annual rate of 6%. That's a big, attractive number designed to get people saving long term.
Okay.
But here's where it just gets wild. How many people out of almost 2 million who signed up are actually getting that top rate?
Well, the answer is pretty stark. And it says a lot about, how complex these financial products can be. As of the last count in August, out of 1.92 million customers who still had the account, 0 people, none, are currently getting that maximum 6%.
Zero. I mean,
Yeah.
zero. That's not just a failure. That feels almost like a bait and switch. How do they even defend that, a 100% fail rate on the main selling point?
Well, they defend it by pointing to the structure of the product. See, the 6% isn't like a guaranteed base rate. There's a basic rate, which is, somewhere between 3.8% or 4.5%. The rest of it, the part that gets you up to 6% that comes from these preferential rates, maybe 1.5 to 2.2 percentage points. But they have these really high hurdles.
High hurdles. Okay, the fine print strikes again. So what are these hurdles? This feels like where we see the bank's interest, maybe more than the savers.
Exactly. These aren't just small conditions. You could almost call them loyalty traps. They seem designed to lock customers into multi-product relationships for the long haul. It's less about maximizing savings for the youth, maybe, and more about securing that customer for the bank. We're talking about needing like 30 to 36 months of consistent salary transfers into that specific bank account.
Okay.
And often that's not even enough. It's coupled with things like regular ongoing credit card spending with the same bank, or maybe holding other products like insurance.
So the banks basically saw a government-backed account as this golden ticket. Lock in young, potentially valuable customers for years, and whether they actually hit that 6%, maybe not the top priority.
It certainly looks that way from the condition.
Give us some specific examples. How tough are we talking?
Oh, they're tough. Look at, say, NH Nong Hype Bank. They require monthly salary transfers for over 50 months. That's more than 4 years.
15 months?
Yeah. Plus, you have to spend at least 200,000 KRW, about $150 on their credit card every single month. Hana Bank is similar. 36 months of salary transfer plus consistent card usage. You basically need perfect banking behavior with them across multiple products for years on end, just for those extra couple of percentage points.
Okay, hang on. So if someone miraculously manages all that perfectly, they get the 6%. But what about the average person? The one who signed up because 6% sounded great. What are they actually getting?
Right, the reality check. The current estimate for the average interest rate across all those 1.92 million users is only about 4.26%.
4.26.
Yeah, and think about this. When the account launched back in June 2023, the average rate for a general bank deposit was around 3.52%.
Right.
So this special policy account with all its hoops and a 5-year lock-in is only delivering about, 0.7 percentage points more than just a standard deposit at the time?
That's a tiny advantage for all that hassle and commitment. It really puts the promise in perspective.
It does.
So why wasn't this clearer? Why didn't policymakers force the banks to lower the hurdles, or at least be more upfront about the likely rate, not just the maximum? Was it just bad design?
Yeah.
Or something else?
It could be a mix. Maybe some regulatory weakness combined with, let's say, very aggressive marketing from the banks. And the frustration is real. It's leading to people dropping out. The sources show about 16.5% of everyone who signed up initially, that's nearly 379,000 people, have already canceled their accounts.
Wow.
Often because, life happens, living costs go up, they can't meet the conditions, maybe they even face penalties for canceling early.
So they got lured in by the promise, couldn't meet the terms, and then potentially lost money.
It's a tough situation.
And all this blowback, it's now leading to calls for change, right? There's a new program coming, the Youth Future Savings. What's the lesson learned politically?
Well, politicians, like Representative Park Chan-day mentioned in the sources, are definitely saying we need to learn from this. The call is pretty clear. The government needs to step in, structurally block marketing that's overly optimistic or, frankly, exaggerated, and crucially design conditions that are actually realistic for young people to meet. The focus needs to shift, from just getting signups or boosting bank loyalty towards making sure young people get a real substantial financial benefit. It's about rebuilding trust.
Right, trust is key.
Yeah.
Okay, shifting gears now from those individual accounts to something much bigger. Macro strategy, decentralization. The government's rolling out this really ambitious plan to push financial institutions hard to support regions outside the big metropolitan areas.
Yeah, this is a big one. And if you connect it to the broader context, it's a direct response to a presidential push to sort of wake up the local economies, the ones outside the Seoul capital region that have often felt left behind. And the goal is huge. Increase policy financing, that's government-directed funding to these regional areas by 24 trillion KRW by 2028.
24 trillion. That's an enormous amount of money to redirect in just 5 years. How are they actually going to make that happen? What's the mechanism?
They're using what they call the Policy Finance Regional Supply Expansion Target System. Basically, setting targets for 4 key state-backed financial institutions. We're talking the big players, KDB, Korea Development Bank, IBK, the SME Specialist Bank, and the big guarantee funds, KODIT and Kibo.
Okay, so using these major public institutions as the main engines, what's the core target? How are they measuring success?
The main metric is the proportion of their total policy finance that goes to these regional areas. They want to raise that from the current level, around 40% up to 45% by 2028.
40 to 45%.
Exactly, which means in absolute terms, the amount going to non-capital regions has to jump significantly, from about 96.8 trillion KRW now, up to 121 trillion KRW annually within a few years.
Okay, setting targets is one thing, but making banks actually do it. What are the carrots and sticks here?
The incentives seem quite strong and pretty direct. First, these institutions will have to create special loan products for regional businesses, offering interest rates up to 2 percentage points lower than standard rates.
Okay, cheaper money for local firms.
Yep. And second, this is probably the key accountability piece. How well these institutions meet their regional lending targets will be directly factored into their management evaluations.
So executive performance, maybe bonuses, are tied to hitting these regional numbers.
That's the implication. Failure could have real consequences for the leadership. It ties the political goal directly to, well, their jobs.
That's a powerful motivator. What about actual, pots of money?
Yes, they're putting capital behind it, too. A 1 trillion KRW regional corporate scale-up fund is being launched over 5 years, starting 2026. That's specifically for investing in regional SMEs and venture companies. And there's also mention of a larger 15 trillion KRW regional revitalization investment fund planned by 2028.
So far, that's mostly focused on the public institutions. What about private banks? How are they encouraging them to lend more outside of Seoul?
This is interesting. They're using regulatory tools. Specifically, they're looking at easing the loan-to-deposit ratio, the LDR, or Yidaeyul as it's known there, but only for loans made to regional SMEs.
Okay, ease the LDR. Explain why that's such a big deal for banks. What does that actually do?
Right. The LDR basically dictates how much money a bank needs to hold in deposits for every dollar, or won, it lends out. It's a key capital requirement rule. By easing this rule specifically for regional SME loans, the government is effectively lowering the capital cost for private banks when they lend outside the capital area.
So it makes those loans cheaper or less burdensome for the bank to make.
Exactly. It makes regional lending more attractive financially, less risky from a capital perspective. It's a clear nudge. using regulation to get them to expand their lending beyond Seoul. And they're also planning to relax lending limits for the smaller local savings banks and mutual finance institutions in those regions too, trying to boost the local capital pool from multiple angles.
Wow, okay, that is a really comprehensive, multi-pronged approach. You've got targets, management accountability, dedicated funds, and regulatory incentives all pushing in the same direction.
It's definitely a major coordinated effort to try and force that decentralization.
All right, finally, let's pivot to the corporations themselves. How are the big financial groups responding? We're seeing signals about governance and social responsibility too, right?
Yeah, and it's interesting because we see sort of two different but equally strong approaches from major players mentioned in our sources. First, you have Shinhan Financial Group. They seem very focused internally right now, specifically on cybersecurity and making sure the top brass gets it. The chairman, Jin-Uk Dong, personally ordered mandatory attendance for all the CEOs and top executives of their subsidiary companies at a recent information security training event.
Mandatory. For CEOs, that's unusual. Security training usually gets delegated way down the chain. Why the pressure from the very top?
Well, the source suggests it's driven by just how fast everything is going digital. The thinking is if there's a major breach, a major cyber incident, the buck ultimately stops with the board and the CEO.
Right.
So security isn't just an IT problem anymore. It's seen as a fundamental management priority. It affects reputation, stability, everything. They're even implementing this new system that clearly assigns responsibility for information protection across different roles right up to the top. Accountability is the key word there.
Okay, so Shinhan's focused on shoring up the digital foundations, top-down accountability. Woori Financial Group, on the other hand, seems to be taking a different tack, focusing outwards on their social mission.
That's right. Woori seems to be really promoting its inclusive finance efforts, even on a global stage like the recent APEC meeting. They highlighted things like OneBiz Plaza, which is a platform offering consulting and financial help specifically for SMEs and small merchants, often the ones who struggle to get support.
But the really unique thing was this branch model they talked about.
Correct. The Goodwill branch. It's directly linked to the Goodwill store concept, which many people know. Since 2023, Woori has been actively supporting the setup of these Goodwill stores. And the core mission there is providing jobs for people with developmental disabilities by selling donated goods. They even showcase these Goodwill piggy banks in their branches, sort of making that social mission very visible to everyday customers.
And this specific model, the Woori Goodwill partnership, it's actually getting noticed internationally.
Apparently so. The source mentions that the U.S. headquarters of Goodwill praised this Woori-style Goodwill store model when Woori's chairman, Im Jong-yong, visited. So it shows that this specific way of integrating a social mission, helping people with developmental disabilities gain self-reliance, is being recognized as a valuable, maybe unique form of corporate social contribution.
Interesting. So you have Shinhan drilling down on internal security and CEO accountability, and Woori projecting its social inclusion mission globally. Is one approach better? Or are they just different facets of the same trend? ESG, governance, social value?
I think they're two critical sides of the same coin, really. Shinhan is focusing on the G in ESG governance, risk mitigation, ensuring digital trust. That's absolute fundamental in finance today. Woori is focusing more on the S, the social value, inclusion, demonstrating ethical application of finance. Both signals are important. Chairman Jin at Shinhan demanding security accountability from the top. Chairman Im at Woori championing social value globally. It shows that these things, governance, trust, social impact, they aren't just optional extras anymore. They're becoming core expectations for financial leaders.
Okay, so let's tie this together. We kicked off with a real frustration around that 6% youth account, 0 people getting the top rate, hidden hurdles, loyalty traps.
A clear gap between promise and reality.
Yeah. Then we saw the government's big reaction, this huge incentivized push to force money out into the regions. Decentralization is a major policy goal.
Using targets, accountability, and regulation.
And finally, we looked at how corporations are responding, with Shinhan demanding top-level security focus and Woori promoting its social inclusion model.
Right, the corporate governance and social value piece.
The thread running through all of this seems to be this balancing act, doesn't it?
Exactly. It's how financial institutions and the policies that govern them try to balance these really ambitious targets, whether it's a slashy 6% interest rate or a 45% regional funding goal with, achievable execution and genuine public benefit. How well they manage that balance, or sometimes fail to, that really determines the level of trust people have in the whole financial system.
So what's the key takeaway for you listening to this? When you see a new financial policy, maybe a savings account, maybe a big investment fund, always look past the headline. Dig deeper. We could call it the 3 Ps to watch out for. First, the practice. What are the actual conditions? Are there hidden hurdles or loyalty traps involved?
What do you really have to do?
Second, the proportion. How much of the benefit or the money actually reaches the intended target? How many people really get that top rate? How much capital really flows to the regions?
Is it widespread or concentrated?
And third, the protection. Who is ultimately accountable, especially for things like digital security? Is responsibility clearly defined at the top?
Practice, proportion, and protection.
That framework, practice, proportion, protection, it's kind of a blueprint, isn't it, for helping you understand how the real world of finance sometimes falls short of those big promises. It lets you read between the lines of the marketing.
Definitely. And maybe here's a final thought for you to chew on. What if? What if policy success wasn't measured just by how many people sign up for something, like that Youth Leap account? What if it was measured only by the number of people who actually achieved the maximum advertised benefit? How fundamentally would the government have to change its whole approach to designing something like the new Youth Future Savings account if that was the only measure of success?
That's a really interesting question. Something to think about. We'll leave it there for this deep dive. We'll catch you next time.
Yeah.